Hello everyone, thank you for joining today's webinar. Our topic today, tax planning best practices for companies doing business in the U.S. My name is Sarah Larson. I am the marketing manager here at Invest Buffalo Niagara, the Buffalo Niagara Region's economic development organization. And I'm the host of this and past webinars on various topics worth diving deeper into for companies who have expanded to Buffalo Niagara or are considering doing so. My job is to find the right experts for these topics. So joining me today are three presenters. First, business expansion into the U.S. expert Carolyn Powell from our NBN offices. Carolyn works with Canadian businesses considering an expansion to our region. Her services are free of charge and confidential to any business interested in doing business here. Invest Buffalo Niagara has been in existence for 20 years now and has helped 390 plus businesses over those years expand here to the Buffalo Niagara region. And to date, over 125 of those businesses are international companies. And our guest presenters today are Rick Tan and Steve Jackson, both tax experts with Ernst & Young, one of many partners we often work with here at Invest Buffalo Niagara when a company is interested in expanding to our region. Rick has more than 20 years of public accounting experience serving the wide range of tax planning and tax accounting needs of large, complex public companies. In his role at Ernst & Young, Rick helps coordinate tax-related activities of companies throughout the Northeast. Rick, thank you for being here today.
Well, thank you very much for having me.
And Steve has been with Ernst & Young for more than 35 years with a focus on bringing investment into the U.S. During Steve's time with Ernst & Young, he spent a number of years in Canada leading the U.S. tax consulting group in the Toronto area and then the U.S. corporate tax advisory practice for Ernst & Young. Steve, thank you for being here today.
It's great to be here. Thank you.
So before we begin today, just a little housekeeping. If you do have questions during the presentation, please type them into your question box in your GoToWebinar control panel. Following this presentation, you will receive an email with a follow-up PDF on tax planning best practices. I will provide you our contact information and a link to our website with expansion tools, if that is something you may be considering. So now, without further ado, I'm going to turn the presentation over to Carolyn to get us started.
Thanks, Sarah, and just want to welcome everybody to the webinar. Again, like Sarah said, I work with a lot of Canadian companies that are doing business and looking to do business in the U.S. And because of those sales on this side and potentially sourcing of raw materials, they're now looking to open a operation or some kind of identity on this side of the border. And with that comes a lot of questions of how to do it and best practices, what's the right form for my company, both legally and from an accounting strategy. So today I thought we would tackle the topic from an accounting standpoint of some best practices and tax filings to help answer some of your questions. I see a lot of these questions popping up frequently, so today we'll be able to get you some of those answers that you've been thinking about. First thing I'd like to do is just kind of poll our audience, Sarah, and see who is doing business in the U.S. or are you considering doing business in the U.S.?
I'm going to share these results with our audience. 75% are saying yes, 25% no, but say that they're considering expansion in the next 12 plus months.
That's great, Sarah. So again, a lot of people are already doing business on this side, at least from a sales standpoint. So my next question to that is, those that are doing sales on this side, have you already established a U.S. entity for your business?
So let's give them a couple minutes to answer these questions and talk to us a little bit about some of the companies that you do work with. When they do set up incorporation, what does it typically tend to be?
Depending on where the owners are coming from, are they Canadian citizens or are there some U.S. partners involved? That answer can always change. A lot of the companies that we do work with are, manufacturers, warehouse distribution. We have some back office operations, some fintech that we're working with that need something on this side and want to get going. Again, it's how do you best service that customer?
All right, I'm going to close the poll and you're going to be happy with these results, Carolyn.
All right.
So 100% say that yes, they're incorporated and they are C Corps.
All right. Our group is educated going into this. I like it. So with that said, I mean, I definitely have things teed up nicely for Rick, and turning it over to you. We're going to talk about, the different forms of entity and what is best for which situation. So thank you, Rick, and turn it over to you.
Oh, thank you. When Steve and I put this agenda together, we did this based on our experiences over the years of the type of risks companies face, the type of compliance requirements that companies will have to deal with, and just some other considerations that we thought would be of interest to companies doing business in the U.S. So the first slide, given that the answer was 100% of the respondents are incorporated in the U.S., I guess we don't have to spend much time on this slide. But generally, that is our experience too, that companies doing business in the U.S. form their own entity. And as a C corporation, you're going to be a legal U.S. entity that is going to be subject to federal income tax and state income taxes to the extent you have activities in various states.
Yeah, I know in many countries around the world, they talk to legal practitioners, and they're often given an alternative to a regular corporation as their operation in the U.S. They're offered a legal vehicle called limited liability company, or LLC. And here on the U.S.-Canada border, that entity is not always viewed the same by the Canadian tax authorities as the U.S. tax authorities. And so, Rick, my experience has been the same as yours. We find that regular corporations are used, not the LLCs.
Rick, can you take a second and explain why a company would choose not to incorporate as a C corporation?
Yeah, there are some interest. There are some times that companies would consider a partnership. If, for instance, in order to penetrate a certain market, it might make sense to go into a partnership with an entity that's already established in the U.S. And oftentimes they'll do that through a joint venture, and that would be set up as a partnership. So you have the foreign entity and then the U.S. entity partner together. As far as a foreign branch, that is not a separate legal entity from the foreign company. That would just be a division, essentially a division of the foreign entity doing business in the U.S. and subject to tax in the U.S., but it is not a separate legal entity. The next slide is the tax compliance. So again, pointing to an incorporated business in the U.S., you'd be looking at income tax filing requirements for federal and state, as I mentioned earlier. In state, that's only to the extent you have certain business activities in those states. But also, you're going to be potentially subject to sales and use tax, and that's a state-by-state requirement, meaning all of the states have different rules and different tax rates and how they have you pay sales and use tax.
And Rick, that's a system I think our audience is probably familiar with. It's very similar to the provincial sales taxes throughout Canada. The U.S. Currently does not have a GST or VAT type system at the federal level. It's just a state sales tax systems.
The third bullet is withholding tax on cross-border payments. So oftentimes we see when there is a U.S. entity that's a subsidiary of a foreign parent, that there will be payments made from the U.S. up to the foreign parent, often in the form of interest, dividends, royalties, and these type of payments could be subject to withholding taxes, but also filings with respect to the amount that was paid, the amount that was withheld, and why the rate that was applied to it was used. So there is work that needs to be done around there. So we just want to make sure companies are aware that when bringing money back from a U.S. subsidiary that's going across border, you have to make sure you're aware of the potential withholding tax requirements on it. And the fourth bullet that we have is payroll tax. And again, we just want to make you aware that that's a system that you have federal taxes, state taxes, local taxes. There's a lot involved with respect to it. So again, we just want to make sure you're aware that there are plenty of requirements around there.
And that's one that can apply if you have full-time employees here in the U.S. at the U.S. operation, but it also might be inadvertently tripped if an employee of the Canadian operation spends any significant time working in the U.S. So have to be very careful around payroll tax, both at the federal and state levels.
So under the federal income tax side, we thought we'd mention a few areas that are of particular interest to a lot of the companies we deal with. First one is fixed asset depreciation. So over the past few years, the U.S. government has allowed an acceleration of depreciation deductions related to fixed asset acquisitions. Normally, companies in the past would have to depreciate the expense over a number of years. Now, from a federal level, you can have an immediate expensing of the cost of these fixed assets, which is a great shelter for your income. It's a good benefit. So a lot of companies are interested in that. And again, we'll point out that federal rules are different than state rules. So although federal will allow it, not all states allow it. But it is a good benefit to a lot of our clients. The next bullet is interest expense limitation. So this one is generally not a benefit to the companies. Essentially, with the new tax reform that came in late in 2017, companies are now limited to an interest deduction equal to 30% of their earnings before income taxes, depreciation, and amortization. And in the past, there was no limit, so a lot of companies were very highly leveraged, and their interest expense oftentimes offset most of their taxable income. And now companies are finding, well, can't deduct all that interest. It's limited to only 30% of our adjusted income. So it's a big difference. And it does impact how companies set up their financing.
And given that our audience indicated that there are a lot of U.S. corporations, we should mention, Rick, that when they make an interest payment to a related party corporation in Canada, maybe the parent corporation or an affiliated corporation, that payment from the U.S. subsidiary to the foreign corporate entity related person, the actual payment itself triggers the deduction, not the mere accrual. It has to be paid in order to be deducted in the U.S. or eligible for deduction before the limitation.
The next bullet is dividends, interest, royalties, management fees. And we're mentioning this because, again, oftentimes foreign parent owns a U.S. entity. That foreign parent wants to know how they can get cash back from the operations of their U.S. entity, and oftentimes that cash back is done through dividends, interest, royalties, management fees. So those areas, of course, are scrutinized by the taxing jurisdictions because they want to make sure that, let's say, they get their fair share, and that is in reference to what I said earlier. There's potential withholding taxes that are taken from these submissions, so that you don't again want to be surprised by remitting $100,000 up to your parent and then finding out, oh, you owe $30,000 of tax on that. So again, our goal with all this is to let you know that there's things to be thinking about, and it's a good idea to have an advisor to discuss these with, because you want to deal with them in the front end before there's an issue, rather than on the back end when it's being brought up by a revenue agent.
When I think your fourth bullet, Rick, ties right into the third bullet. If we do have these cross-border payments like interest, like royalties, like management fees, those are related party payments. And in addition to things like withholding taxes, there is a regime for proper transfer pricing related to those payments.
Right. Absolutely. A huge area of focus of taxing jurisdictions. The concern there is governments feel like profits are being shifted from one jurisdiction to another. So that the US government could argue that not enough profit was recognized in the US related to a sale with Canada, and yet Canada could argue the same thing back. So we want to, again, point that out as a high area of focus for all taxing jurisdictions. So in addition to a federal income tax, then the US, 50 states in the US and 50 different sets of tax rules, so it can get quite complicated. The big thing with companies that come to do business in the US is trying to determine what are the activities they can do in a state that could create an income tax filing requirement for that state. And generally, the type of activities that could create an income tax filing would be between selling into a state, payroll, the employees you have in the state, and property that you have located in the state. And the second bullet talks about, well, at one time there was, and there still is, this exemption called PL 86-272 that said if the only activities a company has within a state is related to mere solicitation of sales, that you are exempt from filing state income tax in that state. However, it's a very narrow definition of what the mere solicitation is. A person going into a state and finalizing a contract for a sale in that state is going to be doing more than mere solicitation. That's going to cause a problem. An employee who, in the course of selling something, helps install a product, helps repair a product, or takes a return on a product, all those little things could take you from mere solicitation to now having a filing requirement in the state.
Yeah, great point.
So, bit of a risk there, and you've seen people, step out of bounds in that area. So, need to be careful. That said, states are getting more aggressive about this exemption under PL 86-272, and they are coming up with something called economic nexus. And essentially, when we're talking about presence, again, talking about having property, having employees, or having sales in a state, some states have basically set thresholds and said, essentially, regardless of your presence in our state, if you have, more than $500,000 in sales, or you have $50,000 of payroll, regardless of what they're doing, or you have inventory that's more than $50,000, we can say you have economic nexus. And regardless of this exemption that I was discussing before, you would still be subject to income tax. So don't want to try and scare anybody away, but just want to let folks know that these are real issues that companies face. Next slide would be sales and use tax. So this is also really managed by the states. So this is different than income taxes, and as Steve said, similar to the GST and provincial sales taxes that Canadian companies are used to. Very low standard to create a filing requirement for sales and use tax. and especially with what's called the Wayfair case, which is a subject that was covered in another session.
Yeah, this may sound familiar to some of you. We did the Wayfair ruling and previous tax webinar. So if you haven't listened to that, once this one's over, later today or tomorrow, definitely go on our website to find the Wayfair webinar, take a listen to that. And, you know, as we talk about it a little bit more, you'll also see in Access US the updated state requirements. So little preview to look for, but yeah, hopefully for some of you, this is a familiar topic.
Yeah, really the big issue with Wayfair was in the past, companies were required to have some sort of physical presence in a state to require it to file sales and use tax. And Wayfair said, you know what, again, the level of activity, and even if you're selling digitally, you don't have to have this physical presence to be considered to have, basically an economic presence in our state, and you're taking advantage of the market of our state, we're still going to consider you subject to sales and use tax. So it's an area of concern to make sure you're square with the authorities on this, and you're not subjecting yourself to any risks. So that leads into our third point, which is we find the best run companies have a good internal process around their sales and use tax, and in understanding what sales are subject to the tax, if any of the sales are allowed an exemption, that they have the proper documentation in place to prove that certain sales are not subject to the tax. You need to make sure you have a process around this area. Next slide is withholding tax on cross-border payments. So again, we've talked about this a couple times already, but we do see, again, a lot of this activity with U.S. subsidiaries of foreign parents. Dividends, interest, royalties, all are the type of payments when made to related parties could be subject to withholding taxes and the filing of certain withholding tax forms.
Yeah, this is a very important area for our Canadian friends, because if they're eligible for tax relief under the U.S.-Canada income tax treaty, then the U.S. statutory rate of withholding, which is 30%, it's very, very high, 30%, can be reduced significantly or even eliminated on certain payments. And so it's very important, if the U.S. subsidiary is looking to make an appropriate payment of interest to its Canadian affiliate, that Canadian affiliate determine if it's eligible for treaty benefits and then proactively assert that it is eligible, because that would reduce the withholding from 30% in the case of interest down to 0 or an exemption. And that would be a big cash flow help to the company.
And I also want to mention a couple other type of things. Again, the management fees, if they're paid cross-border, and then on intercompany sales, is that documentation is key to support your position, because you have to be able to sit across from an agent and explain why it makes sense. And again, these are areas that the agents will focus on. So you want to make sure you're covering yourself contemporaneously.
One hidden issue with management fees is, if you think about it, it's a charge to the U.S. affiliate for time spent by Canadian management, Canadian employees on behalf of the U.S. company. If they do all of that work from Canada, that's fine. We have our transfer pricing issues and documentation issues. But if, in fact, they come down into the United States and have work days in the United States that get built into that management fee, this is creating tax filing obligations and other things for the Canadian company, because it's now earning part of that management fee physically in the United States. So you have to be very careful what that management fee is made up of, because if there's US content, there are even more issues to think about.
Next slide is payroll taxes, and Steve maybe put this in here because he want to make sure we emphasize that this is a very high risk area, and we recommend that all companies doing business in the US use a third-party provider that specializes in payroll tax.
If you're a huge company, maybe you can do it yourself, but most companies aren't, and you need that outside help and you need that expertise, because if you think about it, withholding from an employee's wages is the federal government's money, it's the state government's money. You don't want them showing up saying that you've misappropriated their money. It's not a good discussion to have. So.
Right, because that leads into the second bullet. The officers of the company are personally liable for those payments. So if you fall behind in any payments related to your company in general, make sure it's not the payroll tax withholdings, okay? Because those ones fall directly on the individual. Last slide is transfer pricing. Again, an area, we have mentioned it already a couple times, intercompany sales. The world has basically said that they want, this is jurisdictions all across the world, that basically said they want more transparency on intercompany sales because they are worried about profit shifting and companies that are kind of finagling their prices to move profits to lower tax jurisdictions. So because of all this focus, companies are required to have documentation on how they're coming up with their transfer pricing. And ideally, the price that you charge a related party would be equal to an arm's length price that you would charge a unrelated third party.
And there is reporting to both countries. So in the case of the US and Canada, you're going to have a reporting obligation to both countries for these cross-border related party transactions. You won't be able to tell one story to one government and a different story to the other government.
Right. So high area of focus, and again, just want to make sure that's highlighted in our presentation.
The world keeps getting to be a smaller and smaller place when you're doing business. Thank you guys. That was a lot of great information. And, you know, as I sit through these conversations with companies at the table, it's frequently that the common themes keep coming up over and over again, and having those open and frequent conversations with your accountants on what your business is doing and where it's going and what's happening there. You know, where are you currently selling things, but too, as you're putting those big proposals out there, or you plan on, you know, winning that big bid, talk with your accountants of, okay, I have this large contract out there. It's in this state. This is the volume to it. When I get that yes, what does that mean internally, and how is that going to impact my books, and, you know, maybe some new filings that you haven't done yet. So I'm always telling people, you know, keep good logs and documentations of where your people are going, where your products are going, and have those conversations throughout the year with your accountants, not just come year end and tax filing time. So this is a lot of good information, and, you know, helping people get organized with their paperwork and start thinking about this a little bit differently. So
absolutely, the time spent at the front end of these transactions and the activities of the company will save you a lot of time on the back end when there's already an inquiry from a taxing authority. Planning
and preparing is always easier and not as dangerous as figuring it out afterwards. So, you know, this goes into the next slide that we have up here. You know, what are your next steps? We will be emailing you a follow-up documents from the webinar today. We have a great little 2 checklists here for you of, again, things to consider when expanding to the US, but then on the other side of that, specific to this webinar on preparing for best practices for tax planning. So keep an eye out for that. Hopefully that should help you. and help keep you organized. So just to circle back and recap, Invest Buffalo Niagara works with a lot of international based companies, both overseas in Europe and in Canada, that are, companies that are looking to expand their operations into the US. They have those sales, they have those raw materials. Now they need better support on this side. We're here to help guide you through the process and the due diligence, and help you understand really what is that best next step for your business and for long-term success. When I'm talking with companies, everybody has a different reason why they're looking to expand in the US. Sometimes companies have, a made in US requirement on their product that they need to do, or, they have a government contract that makes them be on this side of the border. Sometimes it's just the cost of doing business and reducing some of those costs. So they're looking to put things on this side, reducing bridge delays and the cost associated with that. But again, just like we've heard today on this, the tax conversation, of reducing the risk to the Canadian headquarters, really get that Canadian corporate company out of US tax filing, out of product liability, as another prior webinar we talked about, and really securing and reducing the risk to that. If something goes wrong in the US, we don't want to take down the whole company because of something on this side of the border. So how can we best help you with that? So a couple different ways you can connect with me and the international team. You can reach out to us anytime via phone, email. On our website, we do have that. You can schedule a call with us anytime. As I mentioned, we have many past webinars and videos to listen to on some of these other topics, on the Wayfair ruling, on product liability, on just some general things to consider. So definitely go find those on our website. You can read some success stories of other companies that have already made the transition and how it best worked for them. We also have a couple expansion guides of great articles, the experts that you're talking with today, and others have written different articles. Some of them are on HR topics to legal, accounting, banking. Definitely a lot of good content here in our guides. So download those, get yourself caught up, and get some questions answered for yourselves. My Access US newsletter goes out monthly. Again, always giving you the latest updates on things as things change and develop in this small world we live and do business in. So take a look for the newsletter on a monthly basis coming out.
Well, I'm going to take the presentation back. Thank you, all three of you. Awesome overview of this specific topic. And helpful to be aware of these items, but also know that there are plenty of resources if they become overwhelming, to reach out and work with a partner that we have here on the US side, work with Carolyn, and use our website for resources. We do have a few questions, so we're going to answer them. And if you do have questions that you want to enter, please type them into the question box in our GoToWebinar control panel. And as Carolyn mentioned, you will receive a follow-up email with a downloadable PDF that you saw there for tax planning best practices. I will provide you with the contact information of our presenters today and a link to our website to take a look at some of these expansion tools if that's what you're considering. So before we let our presenters go, a few questions. What is the difference between doing business in the US and having a permanent establishment?
Well, let me take that one, Rick. Permanent establishment is an international standard that actually deals with a very narrow topic of when a company will become subject to an income tax liability in the other country because of its activities going on there. And so, unfortunately, many people take that term and apply it in many contexts where it's not relevant. The real question is, are you doing business in the other country? Because that starts to create commercial obligations like customs, legal obligations like registration, tax obligations like we've been talking about throughout this webcast It's that doing business in the other jurisdiction that has all sorts of ramifications. And permanent establishment truly is just a very narrow topic of when an income tax liability can be assessed on you for your business in the other country.
Another question here, I have not expanded my business to the US, but I'm selling products in the US. What risks do my Canadian company face handling these US tax returns?
Well, anytime you're selling into another jurisdiction, you have to look at what else, what contact you have within, let's say you're selling into the US, right? How is the product getting there? Who's bringing it there? Those type of things are all type of activities that could cause the US to say, hey, the company that's selling in should be paying tax on that. And that's where you want to be careful and make sure that you really know who is going into another country, what are they doing when they go to that other country, how many days they're doing it, what activities they're doing, because all those type of things can cause a company that thinks, oh, we're just having sales into the country, no other touch points, but in reality there are touch points that are creating an income tax filing.
We often get a question, Rick, where someone maybe has talked to a broker about customs and they become aware of a concept called a free trade zone, and they think this is a very efficient thing to use in their business, and so they bring their inventory into the free trade zone because that hasn't activated the US customs process yet. It hasn't entered the US technically from a customs point of view. Physically, it's entered the US. For state and federal tax purposes outside of customs, it has entered the US. So there are all sorts of non-customs related obligations that would be triggered by having property in a free trade zone. So you really have to look at the whole picture, not just one little sliver of it.
I'm thinking of expanding to the US and incorporating. Who do I speak with first?
I'll take that one, Sarah. So feel free to connect with myself and my international team. We'll talk to you about kind of what your plans are, what you're thinking, why, you're thinking about this now, and then we'll connect you to these great experts like Rick and Steve, and we'll bring some attorneys and some immigration banking people to the table too also. Again, these initial meetings and conversations are free of charge through our offices, and we'll help you start collecting that information so you can make a decision to move forward or not.
Well, that looks like we've covered just a few questions that we had here. So thank you everyone for joining us today. We appreciate you joining this presentation, and thank you Carolyn, Steve, and Rick for presenting. Your emails are on the screen as well, so if anyone wants to reach out to you right away, they can, but we will also follow up in a few days.
Great. Thank you, Sarah.
Thank you.